If you are considering doing a 1031 exchange, then this is the man that you want to meet. He handles 1031 exchanges nationwide. This is Bill Angove. Bill, please introduce yourself.
Hi everyone, my name is Bill Angove. I'm with Asset Preservation. We're a national qualified intermediary for 1031 exchanges. Our company's been around for over 30 years. We do exchanges nationwide. We're actually one of the largest in the country.
Fantastic. And he's been nice enough to come here and answer questions for my viewers here on the YouTube channel. I'm Sherri Walker. I am a real estate agent in Northern California. Let's get started. Bill, why don't you start by telling us what a 1031 exchange is?
Yeah, so anytime, well, this is part of the Internal Revenue Code, Section 1031. It's been on the books for over 100 years. And anytime that someone is selling a piece of investment property, they can defer their taxes, both state and federal, and buy a new investment property anywhere in the United States. And we'll get into the details as we go along, right?
Okay, yes, we will. So the benefits are really deferred taxes. Explain
Correct.
a little about that.
Yeah, so once you own an asset such as a rental house for longer than 1 year, any profit or capital gain you have is considered long-term capital gains. And so the tax rates can be between 15 and 30%, depending on all the different factors that go into that. You've got long-term capital gains tax rate can be either 15 or 20, depending on how much gain you have. You've got depreciation recapture that is taxed at 25%. And then you have the state of California. If your property is here in California, can anywhere go as high as 13.3%. So altogether, I like to tell people that you're going to take about a third of your equity and kiss it goodbye in taxes, both state and federal, if you don't do an exchange.
Okay, so that's one of the reasons we want to do that,
Tax
right?
Deferral, you bet.
Okay, so are there any specific requirements for a property to qualify for a 1031 exchange?
Basically, what the code says is it's any type of property held for trade or business or held for investment.
Okay.
So if we define that further, it's anything except for your primary residence. So single family rental house, duplex, triplex, retail, office, industrial, you name it. It's anything except for your primary residence.
Okay, so you could sell one single family rental and get a duplex or vice versa?
Correct. Yeah.
Okay, so like kind, explain a little bit more about like kind.
Yeah, that's probably the biggest misunderstood item of 1031s these days is like for like means investment for investment. So it's not rental house for rental house. It could be rental house for office building. You could sell an apartment complex and buy 20 rental houses if you so choose. We're seeing a lot of migration out of California. We're seeing people exchange into Idaho, Tennessee, Texas, Florida, non-tax states. So if they do exchange out of California, they need to talk to their tax person about what we call the California clawback law. Because California doesn't forget, even though you exchange out of California, they don't forget that you owe them some tax down the road.
Not surprising.
Yep.
Okay, tell us about the timeline for a 1031 exchange. How does that work?
Yeah, kind of the order of events is you'd put your property on the market, find a buyer, open escrow, and then typically about a week or two before close of escrow, they would engage us to prepare the exchange documents. Of course, before that, we're going to educate them on the process, the identification rules of all that. When they close, then they're not allowed to touch their proceeds. So that's part of our role is help them document their exchange, and we hold their proceeds between their sale and purchase. Once that closing takes place, they have 45 days to identify in writing the potential properties they're looking at buying. They have a total of 180 days from that closing date to close on the replacement property.
Okay, and may I ask what you charge to be the intermediary?
Yeah. We do not charge a consultation fee, a setup fee, or even a cancellation fee. When they actually close escrow and the proceeds are sent to us by the title company, we charge a flat fee of $1,250.
Wow,
so that pays
fantastic.
For one sale and up to 3 purchases. If they're selling more than one, we charge just $200 for each additional property.
Okay, great. That's fantastic.
Yeah. Mm-hmm.
Okay. And can you discuss the different types of 1031 exchanges that are available, such as delayed exchanges or reverse exchanges?
Yeah, what people do, a majority, is what's called a delayed or forward exchange. Old school, we call it a Starker exchange from a famous court case, but that's basically selling first and buying second. That's a delayed or forward exchange. Another type of exchange is called a reverse exchange, and we have all this on our website so people can look if they want to.
Okay, we'll put the website up there for you.
So a reverse exchange allows them using a qualified intermediary to buy their replacement property first. We hold title of that property for them. They have 180 days then to sell their old property and exchange into the one we're holding for them. Much more expensive type of transaction. We charge probably the minimum of $9,500 for that type of exchange.
Why is that one so much more?
Well, number one, they cannot exchange to a property they already own. So we own that for them. We form an LLC.
Okay.
So there's a cost to that. Filing a tax return for the LLC, what we call the parking documents, where we're going to hold title to that property and hold it for them. They have to identify what it is they're going to sell within 45 days of us taking title. And then ultimately there's another set of documents for them exchanging into the new property. The other type of exchange is called an improvement exchange, which will take a lot more detail, but they can make capital improvements to the property they're buying. So I encourage people to do more homework on that, but it's another tool for them to, let's say they're selling for $1 million and they're buying for $800,000. So an improvement exchange would allow them during that process to make that $200,000 of improvements to the property they're acquiring, a new roof, an addition, things like that.
Okay. So when they sell a property, let's say they just sold it for $1 million.
Mm-hmm.
They need to buy a property that is the same amount or more, correct?
It is not a requirement of the IRS that you do that. However, if you don't want to pay any taxes, the general rules are this. Do two things. Number one, reinvest all of your proceeds. So if you're selling for $1 million and you don't have any debt, you're going to pay your escrow and title fees, commission to the realtor, etc. So let's say you net $850,000 or $900,000. So you want to reinvest all of that $900,000 into the new property you're buying. Now let's say you do have some debt. Let's call it $500,000. So we have $500,000 of debt, less we have $500,000 of equity. So the other rule is, number one, spend all your cash, and number two, take on a new loan that's the same or greater.
Okay.
Or keeping it simple, if you take your sales price, subtract out closing costs, commissions, whatever your net sales price is, you want to go buy that or greater in the exchange.
That was the question, whether we take out the closing costs and commissions.
Escrow and title fees, commissions.
Okay, okay, great. And what are some of the common mistakes and pitfalls that people make in a 1031 exchange?
The number one mistake is not educating themselves about the process in advance, because there's special rules with regards to when you identify whether you can change your list and when you can change your list or you cannot change your list. That's probably a big one. Number two, they forget to set up the exchange before they close escrow. So if they close escrow and call me after the fact, they have a taxable event, they're going to pay taxes. So those are probably two of the biggest things, is educating yourself about the process, understanding the rules, specifically identification rules, the exchange equation, which we just discussed, and making sure they set up the exchange before closing.
Okay, great. And how can an investor ensure that they are working with a qualified intermediary?
It's funny you asked that question because we're actually an unregulated industry. Isn't that crazy?
Yeah, that is crazy. That's scary.
Yeah, because at any given time, we're holding billions of people's dollars of money nationwide, and it's unregulated by the state or federal government. The difference is in the qualified intermediary is those that are, most of your major title companies have a qualified intermediary arm. So that's we're a subsidiary of Stewart Title out of Houston, Texas.
Okay.
So they back our performance in the funds that we're holding. Not all qualified intermediaries are associated with a title company. So you have independent companies, and you've got to look at experience, security of the funds, expertise of that staff. How long have they been doing it? Do they carry insurance? Is there bonding, things like that will ensure that if you have this rogue employee, the money will be replaced. And then that's probably the biggest thing in our industry right now is security, just like of your industry, the title company industry, is how easy could a hacker get to my funds, right? And so there are built-in security rules, regulations, things like that are protocols that we follow to make sure that the hacker can't get in and get to those funds, because it happens a lot in the industry these days. People get a hold of emails and see the title report and the wiring accounts and things like that, and the scrutiny is very, very important.
Well, the good news for all of us here in Northern California is that Bill's just right up the street, right?
Correct, yeah.
We're here in Placer County, so that's where he's located, even though he does this nationwide,
Mm-hmm.
right? Okay. Tell us, the last thing that I have for you is, how can an investor determine whether this is the right strategy for them?
Well, first and foremost, they should talk to their tax person.
Okay.
If they use TurboTax and they own 3 rental properties, it's time to find a tax person. and a tax person that understands real estate transactions, because there's those that don't believe in 1031 at all. And they say, don't just sell and pay the taxes. Well, if your intent is to sell this investment property and buy another investment property, then you should get good advice. Do I need to do an exchange? If I bought the property for $800,000 and I'm selling for $700,000, the tax person is going to probably say you don't need to do an exchange unless they exchange into the property 3 times before that, and their basis is so low that even though they're maybe selling for less, they may owe a bunch of tax. So they should first and foremost talk to a tax person.
Okay.
Number 2, talk to us, and we can educate them about the process. From start to finish, we have YouTube channels. We have myself that I can do Zooms, presentations, etc. to meet with clients personally, too.
Fantastic. And is there anything at all that you want to share that I haven't asked you yet?
I think you pretty much got it covered. I mean, it's great that you're educating your clients out there about this great tool. Like I said, it's been around for 100 years. I've been with the company for 25 years.
Well, fantastic. Bill,
Yeah.
thank you so much. We appreciate you being here. And his information and mine is down at the bottom.